Hello, Brokers Are Better Facebook group. I wanted to give everybody an update. There's been a lot of information that's come out here in the last week. As you guys all know, there was the initial kind of tsunami of market-related updates when it comes to margin calls and servicing values, pricing changes, all that good stuff, and that's sort of settled down now. And we're in a whole different phase of what is definitely a crisis management situation. So what I wanted to do is just give everybody an opportunity to ask some questions, but I also wanted to share with everybody some things that are coming up that I want them to be prepared for. I recently did a video discussing how lenders are prospectively going to be viewing forbearance if it happens on or before the first payment on a new mortgage. And this is a big one. And basically, I want to start with how it impacts us brokers because it's a big deal. And it's something that we all need to be aware of. But I've been in pretty lengthy negotiations with all of our wholesale lending partners, and hopefully the rest of the wholesale lenders follow in the footsteps of what we come to here. But basically, what the conversation has been is instead of doing what the rest of the industry is doing right now, which is saying, hey, first payment, if on or before your first payment, the customer goes into default, that's an automatic buyback for correspondents, for people that sell servicing, and even mini core. For brokers, what I've been negotiating is for lenders to take the position that as long as as a start date, April 15th or later, we're working on finalizing what exactly that date's going to be. But assuming that we're able to come to terms, my assumption is that it'll be April 15th or later would be a go forward start point. So all loans that fund after April 15th or after, and let's again understand that date might change. It might be a week later. We're working through that right now. But any loan that funds after that date would be subject to basically a recapture of your compensation if the customer goes into a forbearance agreement on or before the first payment date. So anything that closed before that date, we'd have flexibility on. Now, again, this is a fight that I'm fighting right now. I'm getting, a lot of pushback, but the lenders are working with me. No, I've made the case very clear to everybody that, if brokers were to get hit with a tsunami of compensation recapture because this was retroactive going back to February, that wouldn't be good for the channel. That wouldn't be good for brokers. And even though I know that they're going to take a big hit on this, we need to find some middle ground. So right now that middle ground is hopefully April 15th or after. But I want to prepare everybody because what that means is that any loans you fund after April 15th are going to be subject to a recapture of your compensation if the customer goes into a forbearance. Now, the reason why I think it's so important that we're all on the same page on this is we want to be having the conversation with our customers right now about what their job situation is. We want to clearly define what the situation is with what a forbearance is. This Thursday at 1 p.m., I'm going to be doing a Facebook Live with Scott Sheng. Scott's developed some unbelievable content that everybody can distribute to their customers about forbearance. It's really great. It's really focused on it's consumer facing. It's high quality content. And it really breaks it down to them in a granular way that you can distribute. So him and I are going to do a Facebook Live on Thursday, so you have some material to share with your customers about forbearance. But it's really important that we don't put ourselves in a position where all of a sudden, come May, we're getting hit with all these compensation recaptures because we didn't properly prepare our customers. We have to understand that, like right now, 20% of the customers that have a loan with most servicers are requesting a forbearance. So in their minds, a forbearance is free mortgage payments for 6 months. It's a mortgage holiday. And we have to clear that up. And again, we have to clear it up, period. But we most specifically have to clear it up with any of the customers we're going to be closing soon because they don't know any better. And they're hearing from their friends and family that there's this mortgage holiday that everybody can get. And we don't want to be in a position where we're seeing brokers get hit with these EPOs or these compensation recaptures. So that's a big subject. Again, as I finalize the terms with many of the wholesale lenders, I'm going to circle back with everybody and provide an update. But I think the expectation should be anything that funds after this week will be subject to a compensation recapture if the customer goes into a forbearance on or before their first payment. Now, the rest of the industry, just so we're clear, I'm dealing with this with a lot of different lenders. When it comes to all their other channels, whether it's retail, whether it's correspondent, whether it's mini core, those loan officers or those other stakeholders, this is going back. There is no April 15th or after. It's just if somebody asks for a forbearance on or before their first payment, then you're buying back the loan. We're taking back your commission. That's all there is to it. So this is a big holiday. This is a big win for us to not have to have that 45 to 60 days of exposure going back. And moving forward, we just have to be able to stay ahead of the curve so we don't get hit with some early recapture of our compensation. Other thing I want to talk about, guys, actually, let me see if there's any questions. Any questions on the subject of forbearance? If I see anything here, I'll make sure I answer it. All right. So as far as the next subject I want to go over, it's I think the single biggest thing that we're going to start seeing across the board here in the coming week to 2 weeks is reserves is now going to be at a premium. I've gotten kind of an update of what DU and LP, which are going to be updating their version that they offer later this week. That new version of DU and LP is going to be very, very heavily reliant on reserves. And basically, you're going to see loans that you used to get approved with, with no issue from a DTI perspective and low reserves and high LTV, get a refer. It's going to change in a big way. And I want to make sure everybody's prepared for that because, it's going to change how we pre-approve customers. We're not going to be able to assume we're going to be able to get these deals done anymore because they are making them more sensitive. They are tightening it at the Fannie and Freddie level. The context that I was shared was that, hey, when it comes to loan to values, you're going to see stricter guidance on loan to values. You're going to see heavier requirements on reserves. You're going to see credit quality tightening in a big way. Delinquency in the last 12 months is not going to be something that used to get approved that is no longer going to get approved. The other thing that I was given pretty strict guidance on is that the mortgage insurance companies are going to be meeting this week. I was told that they're having not meeting together, but mortgage insurance companies are meeting separately, even though they probably do meet together. But they're going to be meeting this week to what everybody expects to raise mortgage insurance premiums. So I would just want to warn everybody about that as well. If you're quoting a pre-approved customer about mortgage insurance, the expectation is that the mortgage insurance companies are going to be really hiking those rates in a big way this coming week or potentially next week. So I want to keep everybody ahead of the curve on that. Other big change, obviously, I think that we're seeing is on the refi side. I've seen lenders with pricing adjustments as much as 300 basis points on refi. Definitely on the streamlines and the IRRRLs, but even on just your regular rate and term and cash out refis. And I get a lot of questions on what is that all about? So basically the context there is until we see people start to go back to work and we get over the hump, here's what you can expect is nobody's going to want refi. And the reason why is if I'm a wholesale lender and I close on a refi for a customer and that customer could day one ask for a forbearance, until that fear of that potentially happening goes away, which isn't going to be until when everybody goes back to work and the risk of people losing their job goes away, you're not going to see most lenders aggressively price refi business. And this is going to be a trend that continues each week as the unemployment reports come out and the fear grows. You're going to see more and more lenders just say, I don't want refi business. And it really is that fear of somebody asking for a forbearance before they even get a payment from the customer. So just a heads up on why is that happening. I've been getting a lot of questions like, hey, Anthony, when's the refi pricing going to come back? Why is this happening? And it really is because so many people are asking for forbearances. And until the fear of people losing their job goes away, most lenders are just taking the position of we don't want to refi somebody else's potential forbearance, meaning some other lenders that's servicing their loan now's forbearance. Other big change I want to put out there is really on cash out refinances. So on the cash out side, and I'll start answering your questions. I see a couple of these questions piling up, so I'll get to those in 1 second. But on the cash out refi side, I think that's another area that that everybody can expect some changes when DU and LP get updated. I think we're going to see a lot lower LTV requirement or approvals We're definitely going to see people from a credit quality standpoint much stricter. They're going to see people that have reserves even on a cash out refi. They're going to make sure that the person's not just taking the cash out of their home and they have no money saved outside of that. So just be on the lookout for that. Again, I'm trying to keep you guys 2 weeks ahead of the game. So the things that I found out 2 to 3 weeks ago are the things that were happening last week and this week. The things I'm telling you about now are going to be happening in 2 weeks. I had a lot of loan officers come to me or brokers come to me over the last week and say, hey, Anthony, like, you know, the retail low at this company, this didn't happen to them. This week, that shoe dropped in a big way, whether it's guaranteed rate, movement mortgage, Fairway, all of those lenders made the adjustments to the adjustments that we made in the wholesale channel 2 to 3 weeks ago. So, you know, when it comes to forward locking, when it comes to raising their minimum credit scores, when it comes to lowering their maximum DTI, you talk to any of the LOs in that channel, they'll tell you those changes all happen this week. And if they don't tell you that, it's because it's BS and they're just basically trying to use it as a recruiting mechanism. But the truth of the matter is that did happen. I'm talking to the owners of the companies. I know for sure that those changes happen. So, you know, to me, what the big thing is you know, changing fast and minimizing your exposure to this risk is smart. It's prudent. And the companies that did do that are the companies that will get through this faster. You'll see them come back from a pricing perspective faster, and they will recover. You know, don't listen to any of the rumors. That's all I can tell you is I talk to the leaders of all the lenders every single day. There's all these rumor mongers out there saying, you know, this company's going to go out of business, that company's going to go out of business. Listen, was March a good month for lenders? Absolutely not. But what's happening right now is a natural pullback to prevent any damage that could come from forbearance or default. Once we get through this, another 45 days, 30 to 45 days, all of our wholesale lending partners will be right back in the mix. I've talked to every single CEO of these companies. They've all told me the same thing. They're itching. They're dying to get back in it. There's so much volume out there. There's so much capacity out there. They hate restricting credit, but the reality is they can't take on loans that could potentially go into forbearance right away. And we're seeing the data come out daily, and it's overwhelming. Companies like Mr. Cooper saying that 86,000 customers request a forbearance in 3 business days. So this is real, and you know, we're going to get through it. And the one thing that this whole process has proven to me is that brokers are better, and they're better for a big reason. I know everybody's been real discouraged on all the changes and everything, but you know, right now, I got friends that work for retail lenders that are calling me and saying, hey, Anthony, who can I refer this deal to? Who can I refer that deal to? Because their one company they work for raised their minimum credit score to 680. Or their one company they work for completely stopped doing refis altogether. Imagine that, no refi options. At least you have other lenders, you have optionality, you have the ability to take loans wherever you want. So it's a big deal, and I know that's just my perspective, but that's the truth. If you're talking to any loan officer right now, having optionality is a big deal because people are judging risk and minimizing their risk exposure at different levels at different lenders. So it's a good thing to have the optionality. So I'm going to dig into your questions, guys. So just give me a second to go to the top here. All right, let's see what we got here. Question is, as far as recapture of compensation, is that on lender paid and borrower paid compensation? Yes, that is. So the way that I'm understood is whatever you as a loan originator or broker made as compensation, it would be recaptured if the customer went into forbearance. Now, if you have a situation where you charged hypothetically 1.5 on borrower paid comp and your lender credit was 2, that's something that is lender by lender. Some lenders are going to, based upon your broker agreement, are going to try to recapture the full 2. Some lenders only try to recapture the origination fee, whatever you made on the loan. So go through your broker agreements. You have to figure that out directly. But I would tell you that both borrower paid and lender paid comp would be recaptured in the event of a forbearance before the first payment. If you had to choose, if you have to choose to do a forbearance, will the bank allow you to change your mind? So, will the bank allow you to change your mind? So I think this is a 2-part question. If you reach out to your bank and you request a forbearance, and then before you enter into the forbearance or before that forbearance period starts, you decide to cancel and not be in forbearance, I think that would save you from having a buyback or save you from having your compensation recaptured. I think that would save you. So if the customers start making their payments and made their payments, and the continuity is there. And I would probably say, as long as they made their second payment as well, then I think that would save you. But usually speaking, once that customer enters into a forbearance, the saleability of that loan is not there anymore. So as a wholesale lender, their ability to securitize that loan and sell it goes out the window the minute that the customer enters into forbearance, whether they back out of it or not. So they're in bad trouble. But I would say wholesale lenders would probably work with you if you were able to, get the customer to not do a forbearance, make their payment, and the only requirement, they probably want to see the second payment made as well. So there was some continuity there. Well, not like you just kind of got to do 1 month of payments. If you choose, let's see what we got here. Despite the holiday Anthony just described. Yeah, so a suggestion here was, being able to contact your clients, whether or not you're going to be impacted on the whether you're going to be impacted on a buyback, or a recapture of your compensation or not. Everybody should be contacting their customers right now. I mean, I think this is a big wake up call, because once people realize that, hey, I closed a loan and I could get my whole compensation recaptured because, essentially my borrower could go into a forbearance. Let me reach out to them. Yes, that's one reason too. But the truth of the matter is, I've been pounding everybody for a couple of weeks now. We have to, as an industry, look out for our industry. And the idea that you'd only do it and call your clients when it comes to the ones that are, basically the ones that would jeopardize your commission and a recapture of a commission, and not your other ones, that's not doing what's right for your industry. I think, again, I know there's people that are going to watch this and roll their eyes and be like, oh, Anthony, blah, blah, blah. Like, listen, I'm just being straight with you guys. Like, I don't wake up every morning like, hey, I want to make some videos about forbearance and send them to brokers. Like, that's not what motivates me every day. So, I'm doing this because I want to save the broker channel, and I want to save our industry. And I think the severity of what's going on it's going to have really big impacts. And I can't understate it enough or overstate it enough that the industry will never be the same after this. And everybody that I talk to offline and behind the scenes says the same things. Like, we're about to go through some major, major changes. And, the days of small players entering the lending space, they're over. The barrier to entry is going to be a lot bigger than it's ever been before. Capital requirements are going to go up. Leverage requirements are going to be going up. It's going to be difficult to become a lender, and it's going to be a much harder decision moving forward for lenders to go into wholesale versus retail. And the reason why is because the average margin for lenders in wholesale is about 30 to 40 basis points. The average margin in retail is obviously substantially higher than that. So that's going to change the decision-making for lenders as these capital requirements get imposed and as more credit is restricted. It's going to change things. And for me, what that makes my job is, it makes my job as I have to protect not just the broker community, I have to protect our lenders as well, because if our lenders go away, we go away. And that's as simple as it gets. Brokers need lenders. So I have to look out for the whole entire channel. So, when I say, hey guys, call your customers and educate them about forbearance, yes, protect yourselves, because that's my primary goal, is making sure your compensation that you've been paid stays your compensation, and those people don't jeopardize that. But then call the other customers too, because a wave of forbearance that's out of control is going to put some wholesale lenders out of business. And that would be unfortunate, because we do need as many lenders as possible. And we need the continuity of the relationships we've built to stay here. So again, it's a responsibility. It's not fun. It's not fun to sit there and call, 5-6 months worth of customers, or 3-4 months worth of customers that you don't have any exposure to, but it's doing what's right right now, especially. So what is the difference between making the first payment and then forbearance? So for the lenders, Fannie Mae and Freddie Mac, the guidance that's out there right now this is just on the agency side, not on the government side. So on the agency side, the guidance that's out there to the lenders is, as long as the customer does not request forbearance and does not go into a forbearance on or before their first payment, then that loan can be securitized by Fannie Mae and Freddie Mac. So Mr. Wholesale lender, they close your loan. Borrower makes their first payment. They don't request a forbearance. That loan is fully eligible to be securitized with Fannie or Freddie. Now, if that doesn't happen, now the lender has to retain servicing on that loan and fully absorb whatever burden of responsibility or losses that come with that loan. So it's a big deal. I mean, like, lenders are not set up to be able to handle loans that are not securitized by Fannie and Freddie. And that means every wholesale lender, no matter how big they are. On the Ginnie Mae side, the truth of the matter is, when it comes to this, the borrower requests a forbearance at any given time, first payment, second payment, third payment. It doesn't matter when. That's a liability for the lender. So no matter what, they get hurt on those. But agencies probably 2 to 1 the volume of servicing that most lenders have in their servicing portfolios. Let me see. Are there any topics that are top of mind? Let me see. Wouldn't a borrower have a good chance of asking for forbearance as a refi customer would? Anybody would have any customer that has a loan currently is, a likely candidate to ask for forbearance. I mean, like, the truth of the matter is, if you're projecting, if the projections say that 1/3 of Americans are going to lose their job over the next 45 days, that would tell me that 1/3 of our customers have a chance of requesting a forbearance. So I don't think it's refi versus forbearance request. I think it's just, if you lose your job and the news is telling you that you're eligible for forbearance, remember, there's no hardship required to get a forbearance. It's not like a loan modification where you have to go through this income and asset and hardship verification. The way that this was rolled out, unfortunately, nobody thought through it, it was just a forbearance for all. And basically, as long as you call and request it, you're eligible to get it. Problem with that is, bad things happen when people don't make their mortgage payments, and bad things usually happen to mortgage lenders and servicers. And right now, maybe there'll be a bailout. Right now, there hasn't been any type of announcement of a bailout. I shared an article on Sunday that would tell you that, the head of FHFA, Mark Calabria, is not a fan of bailouts. He's not a fan of bailing out independent mortgage bankers, and I think that's concerning because, it's very scary when you talk about just letting the market play itself out, and just letting these companies that did not have any foresight into this forbearance for all. This was not something that existed ever before. This was something the government introduced and imposed on all the lenders, and now they're in a situation where they have no choice but to approve forbearances for anybody that requests them. So that's going to have some really big impacts on all lenders unless there is some type of bailout. So let me just see what we got here. So the question is, how does this impact the credit score? So while the customer, there's a lot of debate around how forbearance will impact a consumer's credit score. I think right now the situation that is likely to play out is while the customer's credit score is, while the customer's in a forbearance, the servicer is not going to provide any reporting into that customer's mortgage history. So there will be no reporting reported during that period of time. Once they come out, assuming they're able to make all of their back payments. So as we discussed before, you enter into a forbearance for 3 months, you skip 3 months of payments. In the month 4, after the forbearance agreement or period of time is up, you're expected to pay all 4 back payments at one time. So if you're able to make that payment, my understanding is no mortgage delinquency will be reported. However, I from experience and seeing it on people's credit reports in the past, I would imagine it would say that the customer had entered into a forbearance agreement. So I don't know what the implications of that on the customer's credit score is. I've heard people say that's not going to be a positive one. It should have a negative impact. But overall, my understanding is that it won't show as a derogatory missed payment as long as they are able to catch up after the period's over. Can you provide some clarity around what borrowers are being told these deferred payments can be tackled on the end of the loan? So I think we're talking about a couple different things. So forbearance is very straightforward. Forbearance is simply customer calls. They want to enter a forbearance agreement. They can skip, my understanding, it's either 3 or 6 months, depending upon the lender. But basically, they don't make a payment for that period of time. After that period of time's up, so let's just go with 3 months to keep it clean, they would be expected in month 4 to make all 4 payments that are due at that point. The 3 payments that they missed during the forbearance period, and the 4th payment that's due for that month. Deferment, it would be the next route after this. So if the customer could not make their payments and they could not get caught up, usually the servicer would provide multiple options as a go forward. One of them would be a loan modification. The second one would be a deferment, but that does require hardship. That does require verification of ability to repay. That does require an approval process. And that is exactly the point where if they enter into any of those offerings, that they would be marked delinquent and their credit profile would be adversely impacted. So that's a different ball of wax. So Ben Carson stated last night that payments will be able to be put at the end of the loan interest-free. I would imagine that I don't know. I don't know specifically about that. I would imagine that they're talking about a silent second or a loan mod where the payments are reamortized on the back of their loan for Ginnie Mae loans. I can look into that, but again, that's not forbearance. That's definitely 100% would be a loan modification or some type of deferment, and that would be a derogatory impact on the customer's credit score. So, my recommendation to everybody right now is if you're getting your information from the same place consumers are getting their information, meaning CNBC or CNN or any of those media outlets, that you are not an expert. Okay, so what I would recommend doing is spend some time on the AIME social pages. We've spent a lot of time documenting how forbearances work. We've spent a lot of time documenting what happens after the forbearance period, meaning deferment or loan modification options. All of the wholesale lenders have started pushing out information on forbearances. We've also shared a video by the CFPB that's very, very detailed on how the forbearance process works and also what happens after the forbearance process. So we'll share that again in the comments on this post. On Thursday, we'll be doing a Facebook Live at 1 p.m. with Scott Chang and going over how forbearance works and also the best ways to communicate to your customers. But when people tell me, hey, I heard this from this person, I heard this from that person, doesn't matter. You're hearing it from politicians, elected officials, media outlets that are not experts. I strongly recommend leveraging the CFPB, AIME, and your wholesale lenders on what they're putting out. Those are three reliable sources that are vested in the customer getting the best answer and the right answer, not these other people that are just slinging dirt all over the place. All right, so let's see what else we got here. Deferment is scary, blah, 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 isn't forbearance. So yeah, any other questions here? I mean, a lot of these questions are pretty much the same. Any other questions here on any of these other subjects other than forbearance? All right, so I'm just going to finish up with this, guys. Here's my last finishing piece. It's just, I know it's been a tough couple weeks. I know everybody's dealing with lenders, sort of slowing things down, tightening of guidelines, pricing changes all over the place. Believe me when I tell you, I know how tough it is to, day to day. First, just from a credibility standpoint, when you're dealing with your customers, when you're dealing with your realtor partners, loans that are supposed to be closing or taking extra day to close for the wire to come, a lot of things going on. And I just want to make it clear to everybody this, and I just want to let you know, first of all, I'm sensitive to the things that you're going through. I've gone through it myself. I've been a loan originator since 2003. I went through the financial crisis. I was a broker during the financial crisis when all my lenders went out of business every day for weeks. It was brutal. And I remember being in the same, powerless position that many of you probably feel that you're in on a day-to-day basis when these changes happen. But here's what I can tell you is, number one, everybody's dealing with it. So retail LOs, correspondent LOs, broker LOs, everybody's in the same situation. Bank LOs are dealing with it. We just saw Wells Fargo got rid of their jumbo program. JP Morgan's rumored to be getting rid of their jumbo program. Government minimum credit scores have just gone up with all the retail lenders this week. These changes are happening across the board. So level playing field, we're all dealing with them. Just because we announced them first and they're going to be announcing later, it's all the same stuff. But here's what I will tell you is the people, just like during the housing crisis, the people that get through this are going to thrive at a whole nother level because on the other side of this is going to be nothing but green pastures. And I can just tell you right now, this crisis will change lending for a very long time, just as Dodd-Frank and the financial crisis changed things for a very long time. But the people that were nimble, the people that were beginners after the crisis, meaning in the best position to start scaling up, the smallest guys in the business. So if you think about the financial crisis, who are the big winners post-crisis? Movement Mortgage, they didn't exist before the crisis. Loan Depot, they didn't exist before the crisis. Caliber Home Loans, Guaranteed Rate, these are companies that didn't exist before the crisis. They were new guys, and they scaled up after the crisis. So they were basically the newcomers. Same thing here. We're brokers. We don't have any legacy loans. We don't have any fraud. We don't have anything that we have to worry about. Now, some lenders are going to go out of business in all channels, and that's going to happen. But no matter what, the lenders that do make it through are going to be dealing with a lot of crap for a very long time, because there's going to be a lot of customers in forbearance and modification and foreclosure and all that good stuff. So what I would just tell you is this: is get through it. Invest this time in your partners or your realtors, or think about how tough it is to be a real estate agent right now. We're able to pivot and do refis and diversify our business offering. Real estate agents are just shutting down business completely. It's not business as usual at all. So they're going to have a very tough spring, and hopefully things are back in order by the summertime. But what my recommendation is to do is invest in the phone calls, invest in the time with your partnerships development. Let them know you have their back. Make sure they understand that you're with them and you understand how tough it is right now. Go out and try to develop some more relationships, because there's going to be a big opportunity right now to do that. And get ready for being on the other side of this. Meaning, I interviewed Ramon Walker last week. I interviewed Shashank Shekhar. Now's the time to develop a LOA. Now's the time to develop a processor. Get ready for the other side of it, because in 45 to 60 days, the worst of this is going to be over. People are going to start going back to work, and there's going to be a huge refi boom on the other side. And there's going to be a huge purchase boom as well. But I want you guys to understand that the people that are best positioned for it are mortgage brokers. They truly are. So stay optimistic, stay positive, and I'm looking forward to another big month here in April. I know everybody set records in the first quarter and in March. Keep up the great work. Have a great day, and I appreciate everybody tuning in.